Hi, everyone. Thank you so much for joining us today. MACollective is so excited to announce our partnership with PassiveInvesting.com and Rehab Wallet on the MACollective Debt Fund I. We have fund managers have personally invested with PassiveInvesting.com in the past, and we will also be investing in this fund as well. So I am going to turn it over to my partner, Christine, who will take us through some of the partners on this opportunity.
Thank you so much, Margaret. So many of you are already familiar with us, so we will keep our introductions short and sweet. You can read our bios below. So we are MACollective partners, and this is our fourth collaboration together. My name is Christine Shu, and I'm the co-founder and COO of Noblivest, along with my partner, co-founder and CEO of Noblivest, Margaret Kozlark. We're also partnered with Angie Aki from Ohana Investment Partners. And with that, I'll turn it over to Dan to introduce the team at Passive Investing and Rehab Wallet.
Awesome. Thank you. Appreciate that there. So I'm going to introduce myself. Of course, my name is Dan Hanford, one of the managing partners here with PassiveInvesting.com. And my kind of role and responsibility in the company is around investor relations and management, as well as the overall kind of marketing and strategic objectives of the company. And I live and work here in Columbia, South Carolina. So we have 4 children. We have a 12-year-old girl, an 11-year-old boy, and then 2 more girls at 7 years old and 5 years old. So not with us today, but one of our other managing partners is Danny Randazzo there. He's actually living in South Carolina as well, in Charleston, South Carolina, with his wife and his 2 kids, 2 children. And they also have a dog as well, George. And he actually runs primarily on the finance side of everything we do. So does a lot of the fund management and asset management and a lot of the due diligence and underwriting and things like that. And then Kelly Garrett's actually here with us today. So you're going to hear from her today on the webinar. So I'm going to go ahead and turn it over to Kelly, let you go ahead and give an introduction. Then you can toss it back over to me when you're finished.
Okay. Thanks, guys, for having me. I am also a managing partner of Rehab Wallet, or PIC Fund I, and been the private lending side and the lending world now for over 2 decades. Live here in Charleston, South Carolina with my wife of over 20 years, and we have no children. We have no dog. So, but we love Charleston, South Carolina. I've been here. I played basketball here at the College of Charleston years ago. Brought me from the upstate of South Carolina to the low country, and love where we live. So, yeah, glad to have me on the webinar, as well as I hope to answer a lot of questions that you might have.
Thank you, Kelly. And obviously, we can't do what we do here at PassiveInvesting.com and through Rehab Wallet and the debt fund here without our extended team that is behind us and supporting us on a regular basis every single day, day in and day out. So you can see there on your screen our team of experts that are working here directly with PassiveInvesting.com and Rehab Wallet and the debt fund. So got a great team behind us and supporting us. But we definitely, we don't have the time to go through each one of their introductions because each one of them do have a great background, which is why they were selected for those various positions. But I did want to make sure we highlighted them because it is not just me, Kelly, and Danny running the show. So if it was that, it would not probably be as good as it is today. So glad to have our team behind us and allowing us to be able to, support it the way it has been supported these last several years that we've had the fund. So just as we're getting started into this, into the introduction here of the debt fund, one of the things we want to mention is that it is open for accredited investors only. So it's a 506 Charlie, which you may have some questions as to what that is. So please reach out to us and let us know if you have any of those questions. Happy to answer any of those questions that you may have. But really, there's 2 primary ways that most people will that can become accredited. One is via net worth, and one is via income. Net worth is you have $1 million of net worth, not including your primary residence. The second is you have an income requirement, which it's either one of these, not both, but you have an income of $200,000 if you're single, $300,000 if you're married. You have had that for the last 2 years. You have a reasonable expectation for that to continue into the future. So if you have some more questions about that, let us know. But if you've been investing with us or through the MACollective before, you already know that process, and it should be pretty straightforward. But reach out to them if you have some questions, and they can certainly walk you through that because it's a pretty streamlined process that we have set up in order to get that qualification there. So just to give you some highlights on this fund, so it is a debt fund. So we're actually placing debt on real estate hard assets. And the nice thing is that the money is securitized by the underlying asset. So these loans are provided as private loans to fix and flippers, rehabbers, things like that, to be able to quickly acquire a property, do some rehab to it, and then turn around and sell it, or potentially put a renter in there and kind of refinance it, and kind of roll onto that next property there. But as you can see there on the left-hand side, you have for investments of $100,000 or more, there is an 8% preferred return. If you are interested in investing a higher amount, over like say $1 million or more, there are some additional return metrics that we can provide for you there. But those are done on a case-by-case basis. So reach out to the MACollective group, and we can always have that conversation if that's something you're interested in. But right here, you can see the 8% is for $100,000 or more. And the investments that are less than 100,000, so the minimum investment is 25,000. So if you look at there on that 6%, it says 25,000 to 100,000. That preferred return is 6%. Now, there's no return over and above the preferred return, but you get that preferred return. And what's nice about that is that 100% of the cash flows and the profits off this fund gets paid out to you as an investor, up to that 8%, before we as the operators get any of the extra spread on top of that. So that's really where it becomes a much lower risk vehicle or opportunity for you, is that all the cash flows go to you until that return gets hit, right? And so even if there are potentially defaults, we'll talk through some of that stuff here. We have had a few defaults or whatever that I'm sure Kelly can kind of walk through us with a few of those. The nice thing is we haven't lost any money in this fund at all. So it's been a very easy process to be able to handle some of those defaults that we will talk through today as well. But you can get the 8% preferred return for investments of 100,000 or more. Less than that's going to be 6%. We do have a 90-day liquidity option. So this 90-day liquidity option is basically saying you can put your money in as an investment into this debt fund, and then at any point in the future, you can call your capital back out of the fund, and then we have up to 90 days to liquidate out your funds. And so that's where that 90-day liquidity option comes in. So you can put it in for 6 months, you can put it in for a year, 2 years, 5 years, whatever you choose to do. And we have quite a few of our investors that basically put it in, and I said their emergency kind of rainy day fund or something like that. They'll put in here, so it's still making a nice decent return, and they can pull that money back out in the future whenever they choose to pull it out. We do see, as you can see there in the middle, we do have monthly compounding available. So you can either in this fund choose to get a monthly distribution for your 6 or 8% preferred return on a monthly basis, or you can say, you know what, I'd like to compound this. And so basically what happens is every month that 8% return gets put back into the loans, and your balance starts to go up, right? So each month you'll be making a return off the return that you made from the month before. And the nice thing about this is that it doesn't actually take any time to place that capital. And the reason why I say that is because when you initially invest in this fund, it does take us, we usually try to say about 4 to 6 weeks to place the capital. Right now, we're hovering around probably that kind of 2 to 3 mark in order to place the capital. But we always say, we usually say about 4 to 6 weeks to place the capital. But when you're compounding, it's immediately compounded into the fund. It's not that you have to wait another 4 to 6 weeks for that to be placed into the fund. So that's kind of the overall highlights on the from the investment summary here. One thing to kind of highlight one more time here is the power of this compound interest. And so you can see on the top portion there, I guess the middle of the page there, you can see if you put in a $50,000 investment, what those returns look like, and the effective return you can see on the left-hand side. If you leave it in for the entire year, you're actually getting a little more than 6% because you're making money off the 6% every month. And you can see what that does over time, where the longer you keep it in, the higher the overall effective annual return is because of the power of that compounding. And of course, you can see what it does if you're at the 8% level as well, kind of where that actually takes you over time with the money that you're making off the fund itself. So one section, I'm going to cover this middle section here about how your capital is protected. And I'm going to turn it over to Kelly here in just a moment. And she's going to talk about how the fund works and why we like the fund here as well. So the nice thing about the protection of the fund here is that this is a low leverage debt fund, and we're securitizing in real property as a first position lien. And each one of the borrowers signs a personal guarantee. The other nice thing is that whenever you invest in this fund, it's not that, even though it takes 4 to 6 weeks to place it because we have to wait for a loan to actually that's ready to close for us to place that capital in, but your money is not just diversified in just one loan, right? That's not diversification at all. So once your money is placed into a loan, it's immediately diversified across all the loans in the entire portfolio. And that is what allows you to have a lot of diversification, a lot of protection when it comes to your capital, if you will. And of course, as we mentioned earlier with the preferred return, investors are getting paid first via that preferred return before us as the operator makes any of the money on it as well. And then the loans average interest rate is right on 12%. It's actually a little bit more than that right now because of the current market conditions over the last 12 to 18 months. That has gone up a little bit. And I'll have Kelly kind of touch on that here in just a moment as well. But you'd really have to have like more than half the fund of half the loans go be in default before your money would be really at risk, right? Because even if a loan goes into default, it's not that money's lost. We get to get that asset back because we foreclose on it. And then we can either turn around and sell the property or flip it to another flipper to take over another one of our other borrowers, which is one of the things that we've done in the past. Or, I mean, we could also, especially with Kelly's background and stuff, we could rehab it ourselves if we wanted to, that's not our preference. That's not the type of business that we're in, but it is a backup option if we choose to do that we could just renovate the property and turn around and sell it ourselves and get that capital back out. And then of course, because these are short-term loans, these are usually 6 to 9 month loans, with most of them actually being 6 months. These loans are every single month. We have new loans that are being paid off. We also have new money that's coming into the fund. And so we typically have a good amount of liquidity on every month to be able to liquidate out investors as needed and also be able to lend out the money and keep the business going at the same time. So it's definitely a balance between having plenty of borrowers, but also having plenty of money and equity coming in so we can continue to support the borrowers that are coming in and continue to grow the fund. Because right now, I think we're sitting right at about probably 78 to maybe 80 million in equity under management in the fund itself. So we definitely have quite a bit of money that's already put into this fund because it was started back in June of 2020 was the original starting time frame of this fund. The partners got together, discussed kind of the logistics of the fund and put in 7 figures of our own money to get it started, work out all the systems and the kinks. And then we ended up launching it officially to our investors in October of 2020. And since October of 2020 is where we are today with roughly about $80 million in equity that's under management with this particular fund. So Kelly, I'm gonna go ahead and turn it over to you and let you take it over from here.
Thanks, Dan. Yeah, let's just talk about how the fund works, right? And so when Dan and passiveinvesting.com's team or you guys, anybody, if we raising the capital, then we got to put it on the street, right? So our team, actually the ones every day, and that amazing team that Dan brought up is supporting all of us, and we got to put it on the street. That's what we call it. And with some past experience of myself of over 2 decades, as well as people that we've went to hire to put them in the right seats, right people, right seats with a lot of experience in mortgage business as well. We kind of look at each loan and go through it like this. One is that we vet the borrower's experience. That's the main objective here. We want to see experience from him or her before we loan to them. Then we go get a third-party property evaluation. You call it a broker's pricing opinion, or we'll get a full appraisal, one of the two. We like to originate low leverage loans secured by first lien positions only. So the low leverage is right now, we moved it about a year ago, we moved it from 75%, loan to value, we moved it down to 70%. And we have that opportunity and need at times to do that. And we like to be able to have the flexibility to do that based on the market conditions that are on that are out there, and the changing market conditions every single day or week or month. We have a very, very robust banking software and able to service the loans within that banking software. So our bank actually speaks with our software, and we pull payments on a monthly basis. We don't wait until the borrower wants to pay us. We go and collect payments on the first of every month. We ACH it from their account and pull it in our account on a monthly basis. Why do we like the fund? Obviously, as partners, we're invested right alongside of you with over 7 figures. It's an important piece of my emergency fund and my family's emergency fund that we keep, almost a year's of supply of emergency fund inside this fund ourselves for my family. Dan and Danny do the exact same thing. It is securitized by hard assets, right? So the hard money business just means that it's collateralized by a hard asset. It's not a stock, it's not crypto, it's a hard asset, it's real estate in first lien position. There's no long-term commitments for your capital. You can get your cash whenever you need it. Obviously, we have short-term money coming in and out on a daily basis. It is an amazing balancing act between the investor relations side, you guys, and the operation side, kind of my side. So every day money's, we got loans closing today. We have loans getting paid off today. We have investors wanting their capital back today. And it's just a balancing act, a continual balancing act, as well as new money coming into the fund. So we balance that out amazingly. And lots of communication are going back and forth with our teammates to ensure that we have the right balance every day. The monthly cash flow distributions and increased ROI with monthly compounding returns. Dan touched on that. That's a big factor personally. I don't take distributions. I leave my distributions in so that they can compound on a monthly basis. We have a very low default rate. I was getting some stats in right before we joined today. We have done including this month, we'll have done over 1,135 loans in the time that we've been around. So it's June of 2020. And we have 1 default. We pride ourselves on that. I tell everybody, we can't expect that to continue. Things are going to happen. But when we had to take that loan back from a borrower, that things happen in people's lives, right? They have deaths, divorce, anything can happen. Maybe just get overwhelmed. And we took that 1 loan that we had a default and took it back, put a locksmith in 24 hours, had the locks changed, sign in the yard, cash offer in 48 hours. And, the fund made $44,000 on top of all the back interest and attorney fees. So, it doesn't scare me because I know I mentioned earlier that I was been a lending business for 2 decades, but in that same time, I flipped the exact same time. So I was a flipper for over 18 years. So it doesn't scare me at all. If we have to, and we'll get in that in a little while, it's not what we want to do, but if I had to start and open up another division called a REO or a bank-owned real estate owned within our fund, I would just do it. And it's not a scary thing to me. I've flipped many, many, many houses in my career. And if we had to do that, we would. But what we try to do as well is before any of that happens is that we call investor A to get in touch with investor B, that the investor B might just be having some problems. Things are happening. Kid got sick. Cancer hit a home. Anything can happen. And so we call different investors to get in touch with one another, and maybe this investor just assumes this loan, or this investor just pays cash and gets him or her out of the way, back taking care of their family, and that we can take over that loan and handle it with care. So we've been able to do a lot of that instead of having to take some loans back, but if we have to, we will. Dan, you want to take us to the next page? this page right here just talks about different type of borrower profiles. It says Kevin's been invested in Columbia market for over 5 years. This was a fourplex in Columbia, South Carolina. I love multifamily. You know, if we can do traditionally, your conventional loans are, you know, four units and below. But we've done small multifamilies like this, and his ARV, so he purchased it for 185. He put 15,000 into the rehab. His ARV was 300K. So he fell at that 70% after repair value that we really like. And his exit strategy is to refinance it in 6-month term and get Rehab Wallet kind of out of the way, and he gets more of a traditional loan. He kept the property and cash flow, and I know this borrower very well, and he still has it today. This is another investor. It's a single family home in Charleston, and he's been around for over 3 years. Rehab Wallet funded a loan with him in a single family property. Purchase price was 164. He put 10% down. So he had 147,600 in it. And he's using his own money for the rehab of the property. So the ARV was 256. So that takes us to 58% loan to value. His exit strategy was to flip it. We have a lot of people that like to bring their own rehab money to the table. And some people say, why? It's just because they don't want to pay the interest on it. That's fine. We still require a lot of communication back and forth to ensure they get in and out of that loan in 6 months. The last person has been investing in, and this is in Camden, South Carolina. She's been in the flipping business or rehab business now for over 4 years, has been an active real estate agent also during her time. Her ability to get the precise ARV is very important to Rehab Wallet due to her experience and knowledge of the area. So we love if you're a flipper and a realtor. That tells me a lot about you. That tells me you're probably going to have budgeted correctly, or are you actually going to have done your scope of work based on a good after repair value. And her purchase price on the latest project is very low at 48,000, and she needs 72 in repairs, and her exit strategy is to flip the house in less than 4 months, and she did. So yeah, we have some people that it's a lot of questions I have over 6 months. If that happens because of just, again, things happen, right? If they exceed over 6 months, we will extend the loan for an extension fee, obviously. And so we have been charged them another point of interest for another 3 months. And so we work with them to get it through. But a lot of people are in and out in those 6 to 9 months because they don't want to pay that higher interest. And you can see where Rehab Wallet's presence is. You know, we love Charleston, Columbia, the Carolinas, Georgia. And I say that because that's where I flipped. And so sometimes the team on the lending side obviously is my job, and it's just kind of following my culture, right? So that's my comfort zone. So that's where we've been really ingrained. As of last month, I was doing some numbers, and 92% of our loans was in Charleston, South Carolina last month. I think we did right at 9 million in August, and 92% of those loans was right in our backyard. Danny and I both live here, and then Dan lives right up the street in Columbia, South Carolina. And our presence is heavily in South Carolina, honestly. But we love North Carolina and we love Georgia. There's reasons why we might not go on further south in Florida. There's different things that the foreclosure laws, we have to delve into that. I have an amazing director of compliance, and we have her research how long it takes us if we have to foreclose in Florida, in that state. Well, it takes over a year to foreclose on somebody there. That's not a presence we have to be in when I can do a lot of damage, if you will, and put a lot of this money right in our backyard in the Carolinas and Georgia. So that's where we like to be. And sometimes I even am in awe of this, and tells a lot about our team. But we funded since inception right at $224 million in loans. 85.9% of our loans are return borrowers. So we call it knock your socks off service. We pride ourselves on that. And we're personally personally. I'll be going to another one on Thursday. My whole entire team is personally at a lot of real estate investment groups, meeting these borrowers face to face, getting to know them personally. And I feel like that's why they're coming back to us, on top of the service that the entire group gives. And since inception, we have done right at 1,100 loans. And so that's a lot of loans that we do on a monthly basis, and funded almost $224 million. And I'll talk about the default rate. We have one default that we had in Georgia. And I've spoke a little bit about that, but we were able to quickly put that back on the market. I don't know why some people ask, like, well, you know, like the investor or the borrower should have done the same thing. Well, yeah, we were trying to talk him into that. Like, just go put it on the market. He was just, he had nostalgic, heartfelt attachment to that home. And he was trying to refinance, and he just couldn't refinance it out. And he waited and waited. We gave him multiple times to get out of it, but it was too long. We decided, hey, let's shut the door and foreclose on it. We did. We sold it ourselves and made a profit on it, as well as the back interest and the attorney fees. All right. I don't know that we need to go through all these FAQs, but Dan, I'll turn it back over to you.
Okay. All right. Sounds great. So I'll cover a couple of these little highlights here, and then I'll turn it over to the MACollective team, and you guys can come up with some of the questions, or throw out some of the questions to Kelly and I, and we'll tackle them as they come up. So I'll say there's two on here that I really wanted to touch on, and I think both of them I've kind of already touched on once before, but I just want to reiterate it, because I know sometimes when I'm going through things, I can talk a little fast. So sometimes going through it again can sometimes help it sink in a little bit without having to rewatch the whole video again. So, this second question on here is my capital diversified across all of the loans in the portfolio, or all the loans in the fund? And the answer is yes, right? So the moment you put your capital in and it gets placed into the fund, you're diversified across all the loans in the portfolio. And, one of the, strategies with this is, I had a friend of mine down in Florida that was doing something similar to this, but he was doing it through like a middleman type person that would go and find the loans. That middleman would connect like the borrowers and the equity people, and then he would basically make a spread off of it, right? So he would make maybe up 1 to 3 points depending on the loan and the structure and the setup. And he was doing it for 2 or 3 years, and it was a good friend of mine, and he was always bragging about how much money he was making off of it, because he was making, I think, like maybe 10%, and his buddy was making an extra like 1 to 3%. So they were still doing a very similar loan interest rate like we have here. But the problem is that he was only diversified, or he was not diversified at all, because he was only invested in the one asset with all of his money. And so he did this for like 2 or 3 years. And then there was one loan that came up, like 3 years into his investment with this, middleman person. And that one investment wiped out all of his profits from all of his prior deals that he was in. And it's because he was putting all of his money in just one deal at a time, right? I think he maybe had 2 or 3 going, but he still had all of his money in just one loan, instead of putting in a fund like this, which allows you to still have great return metrics, but you are now diversified, and your risk profile is a lot lower, because you're now diversified across all of the loans immediately in the entire fund itself. So it's a very, very important distinction from a risk perspective, that you are diversified across all of them. So even if we have 5%, 10%, 20% of the loans that go into default, you are still, your capital is still protected, right? So it's a very important piece to understand there. One of the other pieces on here that I wanted to share with you is just reiterating how long it takes to place the capital, right? So right now it's usually between about 2 to 3 weeks. That can flux. Sometimes we place it as fast as maybe a couple of days to a little bit longer than that, but I would just plan and expect for it to be placed within about 4 to 6 weeks, and then hopefully you'll be surprised and satisfied when it gets placed sooner than that. But that's kind of our target, is to make sure that all of the new money that comes into the fund is placed into a loan in the fund within a 4 to 6 week period of time. And then the last thing I wanted to touch on before I turn it over to you is about our co-investment in the fund. So actually, while Kelly was talking, I was like, I'm pretty sure it's more than $1 million now. So I pulled it up, and between the three partners, we're a little over 2.1 million that's invested and co-invested with you inside of this fund. So it's not that we're just putting this fund together and bringing investor money in. We're putting our own money into this fund and making sure that we also have skin in the game, so that you can also see that we believe in this product. And it's one of those types of offerings that there's very, very little risk for any type of capital call or anything like that, because with capital calls, it's usually because you're paying some sort of expense or debt that needs to be paid. And really here, there's not really much to have to be paid out. Now, of course, we still have to, with the fund, we're paying for the team and things like that, and and some of our software and stuff like that. But that's a fairly minimal cost compared across the entire profitability of the fund. And so it actually allows for us to have a lot of risk mitigation from that perspective as well. So anyway, all right, I'll stop talking now. I'm going to turn it back over to the MACollective group. Let you guys go ahead and fire away up some of your questions, and we'll go ahead and wrap this up here in just a few minutes.
All right, thanks so much, Dan. Appreciate it. Since you mentioned capital call, I just want to dive into that a little bit more, as the market and a lot of our investors may be invested in multifamily or have experienced a capital call or know someone that has, or heard of it. There's a lot of fear and anxiety around capital calls at this point. So correct me if I'm wrong. It sounds like you guys have never done a capital call, but at what point, if ever, would there be a need for a capital call? If you can speak to that at all.
Yeah, I mean, that's the nice thing about this fund, is that the only time we really need capital is when we're placing money into a loan. So the easiest thing for us is that if the market starts to shift, or something happens where we need money because you have borrowers, well, we just turn away borrowers or stop lending the money. And so we don't necessarily have any scenarios where we would really need to do a capital call, because once the money is placed into a loan, we don't really need money to be able to make that continue to work for us. So once that loan gets paid off, there's more money that'll come into the fund that can be distributed out. So I really don't see a lot of risk at all for any type of capital call per se in this type of a fund. I don't know, Kelly, if you could think of another scenario, but I don't really see any scenario with the debt fund where you would really need to even have a capital call for this type of an offering.
Okay, awesome. And so let's talk about, I know we went through a few borrower profiles as well. I know one of the things you all look at is borrower experience. Can you talk a little bit about, you have 86% approximately borrowers returning and coming back to you for funds. What is their experience level? Are these very experienced flippers? How many years have they typically been doing this? I know, Kelly, you said you meet with a lot of them face to face. So can you give us kind of an overview as to their general profile or their experience level?
I would say the average borrower has 3 to 5 years experience. You might get an anomaly every once in a while, but typically the way it goes in life or on the real estate world is that people go into single family for a little while, and then they'll be on your webinars or passiveinvesting.com's webinar, and all of a sudden they want to be multifamily investors as well. So they move into that next journey of multifamily or RV parks or something like that, right? And so we catch them in that 3 to 5 years experience. I told somebody the other day I might have been the only person that stayed in flipping for 18 years, but I enjoyed it. It was super lucrative for us. At the same time, kind of fit who I am. But there are those that also have a ton of experience like that as well. But experience, we require them to show us a HUD settlement statement, showing how many they've done in any 12-month period. And we won't do any loan for anybody that has not done 2 or more.
Okay.
For no first-time borrowers, we just won't touch them. And if somebody is doing a rehab, over $100,000 rehab, they must have 5 years or more experience, because I know what that feels like as a flipper. That is a very extensive rehab. That is very extensive. It should, and it typically will take somebody more than 6 months. So if somebody's saying they're going to do 100K on a rehab and they're going to take a 6-month loan out, it's just hard to do. You better be very good at your job in order to do that big of a rehab in that short of a period of time. So, and that's from purchase to then selling it on the back end.
Gotcha. Okay. That answered my next question, which was on application process. So thank you. So of the, I believe it was 224 million since the fund has been open, what is the current amount that is actively invested in loans right now?
I think I might have mentioned it earlier on in the webinar, but we are right at about 78 to 80 million right now of active equity in the fund right now.
Okay, thank you. And I know, I think it was 1,100 loans approximately that have been initiated or open. Do you know, or have most of those, I'm assuming if they're 6-month terms, have most of those gone full cycle?
They have, we have, as of August the 31st, we have 857 loans though, that total number of loans full cycle to date. So it's actually started and actually full cycled out. So you probably can get that delta between those two numbers of what's actually left. Again, we have a few in the extensions, which is fine. And then you have some in that 6 to 9 month period. We charge a higher rate for somebody that chooses a 9-month loan, but you know, but that's probably about 250 loans that are still cycling in and out.
Okay. Those are all the questions I have. Thank you so much for everyone that was on the call. Thank you to PassiveInvesting.com and Rehab Wallet for partnering with us at MACollective to bring the MACollective Debt Fund to our investors. We are thrilled about this opportunity and hope as investors you are thrilled and looking forward to partnering with us on this. So please reach out to either myself, Margaret, or Christine about next steps and how to get started. Thanks, everyone. Have a great day.